portfolio does not need to explode to destroy you. It only needs to leak. That is the part beginners almost never understand. They think risk arrives wearing a siren. They imagine a crash, a scandal, a recession, a black swan, a red screen, some cinematic disaster that announces itself like thunder. But most of the real damage in investing is duller than that. It drips, it drains, it hides in ordinary language, it dresses up as convenience, it flatters your emotions, it borrows the costume of safety, and then puts a hole in the bottom of your bucket. I have spent my life watching money move. I have watched it flood toward noise. I have watched it run away from silence. I have watched intelligent people lose fortunes through complexity, and I have watched ordinary people build real freedom through simple decisions repeated for long enough. And if you forced me to compress one hard truth into a single sentence, it would be this: compounding is not hard to find, but it is very easy to puncture. That is why I get uneasy when people talk about ETFs as if the wrapper itself guarantees wisdom. An ETF can be a fine tool. In many cases, it is one of the best tools most people will ever use. Low friction, broad exposure, fewer ego decisions, fewer chances to mistake activity for intelligence. I like that. I have always liked structures that remove unnecessary stupidity from the process. But a good vehicle is not the same thing as a leak-proof vehicle. A diversified bucket with 3 holes in it is still a bad bucket. Most people do not lose with ETFs because they picked the wrong decade. They lose because they let 3 hidden drains sit open for years. The first drain is the fee drain, the second drain is the yield drain, the third drain is the headline drain, and the reason these 3 drains are dangerous is not that they look reckless. It is the opposite. They look reasonable, they look polished, they look efficient, they look like the kind of decisions a responsible person would make. That is what makes them expensive. Let me say it another way. The stock market is already difficult enough for the average person because the market charges tuition in patience. It demands that you wait while your instincts scream. It demands that you stay steady while your neighbors chase excitement. It demands that you accept boredom in exchange for freedom. That is already a high psychological price. When you add hidden leaks on top of that, you are not just making investing harder. You are forcing your future self to run a race with weights tied to both ankles. The average worker cannot afford that. A wage earner does not have infinite recovery time. A worker does not get to casually lose 10 or 15 years and pretend it was a rounding error. A portfolio mistake made at 30 is not the same as one made at 70, but both are punished by the same mechanism. Time keeps moving, and the capital that should have been compounding for you is instead compounding for somebody else. That is the fee drain. People hear 1% and treat it like lint. They hear 0.5% and assume it belongs in the category of trivia. They hear a few basis points and mentally file it under details for finance nerds. That is because the human mind is not built to respect small annual friction. It notices car crashes. It does not naturally notice taxes on momentum. It notices visible pain. It ignores silent subtraction. But money does not ignore silent subtraction. Money obeys math, not mood. If you put $200,000 into a fund that earns 10% before fees and leave it alone for 15 years, the gap between a 1% annual expense ratio and a 5 basis point expense ratio is not cosmetic. It is not some little administrative nuisance. It is a 6-figure transfer of ownership. The money did not vanish. It changed address. That is what most people miss. They think the fee is being charged on gains. They think of it as a haircut on success. It is worse than that. It is being charged on the capital base itself, year after year, whether your emotions noticed it or not. The fund manager is not reaching into your bucket one time. He is standing beside the bucket with a tube permanently attached, drawing from the same pool that your future life depends on. You work 40 hours, you budget, you delay gratification, you skip the expensive car, you stay out of bad debt. You carry the emotional burden of not spending what everybody around you is spending, and then after doing all that, you casually surrender tens of thousands of dollars because the word expense ratio sounded too harmless to examine. That is not a strategy problem. That is a dignity problem. You should never be casual about permanent claims on your compounding stream. Every ongoing fee is a rival owner. Every percent that leaves your bucket every year is another silent partner sitting at your table, eating before your children do. I am not saying a lower fee automatically makes a fund superior. I am saying a high fee has to prove it deserves to exist. It should not get a free pass because the marketing deck is attractive, the ticker is familiar, or the fund appears on television beside confident people in expensive suits. Most people reverse the burden of proof. They assume the fund is innocent until proven guilty. I assume every leak is guilty until proven useful. That mentality will save you money. The second drain is more emotional. It is the yield drain. This one traps people who want to feel progress. I understand the temptation. Cash payments feel tangible. A dividend arriving in your account feels like the market is rewarding you for being patient. It scratches a very human itch. It converts an invisible process into a visible signal. And because people are emotional creatures living inside noisy economies, they start to confuse that signal with strength. That is where the leak opens. A big yield can be income. A big yield can also be distress wearing makeup. That distinction matters. If you buy a high-yield ETF because the payout number makes you feel secure, but the underlying assets are weak, over-leveraged, rate-sensitive, structurally stagnant, or priced for decay, then the cash you are collecting is not evidence that the machine is healthy. It may simply mean the machine is distributing more while corroding underneath you. Plenty of people have learned this the hard way. They stare at the quarterly payment and ignore the shrinking body attached to it. They celebrate the fruit while the tree is quietly dying. They tell themselves they are building an income stream while the asset base slides year after year. On paper, it feels productive. In reality, they are letting one hand distract them while the other hand steals the foundation. That is not yield investing. That is anesthesia. The market is full of instruments that can look generous for exactly the wrong reason. If the underlying companies or bonds are under pressure, if debt burdens are heavy, if credit conditions tighten, if rates move against them, if growth is weak, if capital is fragile, the yield can rise because the price is falling, not because the engine is healthy. New investors see the number and imagine abundance. Experienced investors ask the only question that matters: what had to go wrong for this yield to look so attractive? That question will keep you out of a lot of trouble. Take the seduction of high-yield bond funds on the surface. A 6% or 5% and a 0.5% payout feels like maturity. It sounds prudent. It sounds like the adult alternative to speculation. But if over the long stretch the fund price drifts downward badly enough, the income is not rescuing you. It is distracting you. You are not receiving a gift. You are receiving a partial refund while the underlying value erodes. A worker who does not understand that difference can spend 10 years congratulating himself while standing on a slower burning version of the same mistake. This is why I have always cared more about total return and business quality than about the emotional theater of cash distributions. A distribution is not proof of strength. A yield is not a halo. A payout is not a moral virtue. It is just one line on the instrument panel, and in many cases it is the line most likely to seduce an impatient mind. The market is cruel to people who crave visible reassurance. That is why I talk so much about psychological incentives. You are not just managing money. You are managing your own hunger for proof. If you do not understand that, you will keep selecting investments that feel good in the first quarter and betray you by the 15th year. The third drain is the ugliest because it attacks the mind before it attacks the portfolio. It is the headline drain. Most bad investing does not begin with numbers. It begins with a story about easy income, a story about the famous investor who sees what the crowd is missing, a story about the ETF that could triple, a story about a once-in-a-decade setup, a story about a safe shortcut, a story about how this one product gives you yield, upside diversification, low fees, recession resistance, and peace of mind all at once. That is not analysis. That is bait. And bait exists because your attention is profitable. The modern media machine does not get paid when you reach financial independence. It gets paid when you click. That single fact explains more bad investor behavior than most textbooks ever will. The incentives are not aligned with your outcome. They are aligned with your pulse. If the article can make your heart rate rise before your brain slows down, it has already done its job. Whether you later make money is not part of the compensation formula. You need to understand how dangerous that is. The beginner enters the market feeling uncertain. He wants clarity, he wants guidance, he wants somebody to tell him what matters. The financial media steps in and offers him confidence packaged as urgency. It offers him headlines engineered to trigger emotion first and analysis later. It flatters him with immediacy. It makes him feel one click away from secret access. And because he has not yet built an inner scorecard, he confuses stimulation with insight. That is how the third drain opens. He does not go directly to the fund. He does not study the holdings. He does not look closely at cost. He does not examine the long-term chart. He does not ask why the yield is high. He does not compare what is being promised with what the underlying assets have historically delivered. He reads a headline, borrows conviction from somebody else's tone, and sends his capital into an instrument he does not truly understand. That is not investing. That is outsourcing your judgment to an advertising model. I have no objection to information. I object to persuasion disguised as information. There is a difference between a source that helps you inspect reality and a source that needs you emotionally activated, so the page can monetize your attention. If you do not learn that difference, you will keep handing your money to people whose only real edge is knowing how to make ordinary things sound urgent. The market does not care whether you are persuaded elegantly. It still takes the money. This is why I prefer a simpler ritual. Go to the investment itself. Go to the facts before the commentary. Go to the structure before the story. Go to the instrument panel before the sales pitch. Look at the expense ratio. Look at the long-term behavior. Look at the holdings. Look at the yield, but never in isolation. Look at how the asset behaved across different environments. Look at whether the thing in front of you is actually helping you become an owner or simply helping somebody else harvest your attention. That sequence matters because it reverses the modern order of corruption. Most people start with excitement, then move to opinion, then maybe reach the facts if they have time. I start with the facts, then decide whether the opinion deserves a seat in the room. That habit sounds small. It is not small. It is one of the dividing lines between those who slowly build wealth and those who repeatedly donate wealth to narratives. You do not need to become an analyst sitting in a tower full of terminals. You do not need to build a quant model. You do not need to read every white paper in the industry. But you do need to stop behaving as though a low-fee wrapper automatically absolves you from thinking. A broad market ETF with very low cost, held for a very long time, can be an extraordinary machine for ordinary people. I have said many versions of that truth for years, but the reason it works is not magic. It works because it keeps the bucket simple, keeps the leaks small, keeps turnover low, keeps ego out, and lets productive assets compound without too much human interference. That last part is harder than people admit. Human beings love interference. They love tweaking. They love reacting. They love feeling informed. They love receiving little signals that say, "You are doing something." The problem is that wealth is not built by the feeling of participation. It is built by the quiet retention of economic value. That is why these drains are so expensive. They are attached to emotional needs. The fee drain flatters your laziness about details. The yield drain flatters your hunger for visible reward. The headline drain flatters your desire to feel ahead of the crowd. All three whisper the same lie. You do not need to inspect the bucket. You only need to admire what is written on the side. That is how adults stay broke in respectable ways. It is also how intelligent people sabotage themselves without ever having a dramatic story to tell about it. They will not say, "I gambled everything on nonsense." They will say, "I bought diversified funds." And that sentence will be technically true while still concealing a decade of avoidable leakage. You must become more ruthless than that. You must learn to treat every portfolio choice as capital allocation, not self-expression. You must learn to separate signal from sedative. You must learn to distrust anything that tries too hard to feel easy. A worker has one enormous disadvantage in financial life. His labor income is usually linear, his time is finite, his energy is exhaustible. His attention is constantly under attack. That means his investing system must be cleaner than the system of someone already sitting on a mountain of capital. A billionaire can survive stupid friction longer than you can. A fund manager can survive a few bad decisions more easily than you can. A television personality can recommend nonsense and still get paid. You cannot. You need your bucket to be as intact as possible. That means fewer leaks. That means fewer seductions. That means less romance about income and more seriousness about total economic output. That means less fascination with what strangers are saying this week and more discipline about what your own instrument panel is telling you. A lot of investing advice becomes useless because it is aimed at the fantasy self. The fantasy self is patient without effort. The fantasy self never envies anyone. The fantasy self is immune to headlines. The fantasy self enjoys spreadsheets more than stories. The fantasy self will diligently verify sources before buying anything. That person does not exist. You exist, which means the system must be built for a human being with emotions, impulses, boredom, vanity, impatience, and a deep vulnerability to persuasive language. If you do not build for the real person will blow holes in the bucket and then act surprised when it empties. This is why I like simple filters. I want rules that protect me from moods. I want low friction where it helps and high friction where it saves me. I want decisions made in calm moments to defend me in noisy moments. You should want the same. Before you buy an ETF, ask 4 unsentimental questions. What does it own? What does it cost me every year? Why is the yield what it is? What has the thing actually done over a long stretch? Not just in the recent mood swing everyone is talking about. Those 4 questions will eliminate a remarkable amount of foolishness. And then there is one more question. The question underneath all the others. Who is the product really serving? If the answer is me, you should be able to explain how. If the answer is murky, if the value proposition depends on excitement, if the appeal rests on a headline, if the yield looks like a sugar rush, if the fee quietly siphons away your compounding, then the product may not be serving you at all. It may be serving the ecosystem around it. The issuer, the distribution channel, the platform, the media engine, the personalities using it for content, the broker gathering assets, everyone can get paid while the owner of the capital remains the least protected person in the room. Do not be that person. You have fewer truly important investing decisions in life than you think. The world makes finance look like an endless stream of tactical opportunities. Most of that is theater. The real game is simpler and harsher. Keep what you earn. Allocate it intelligently. Minimize unnecessary drains. Stay in productive assets long enough for time to help you. Refuse to confuse motion with progress. Refuse to confuse payout with strength. Refuse to confuse publicity with truth. If you do that, you do not need brilliance. You need endurance. And endurance becomes much easier once the leaks are sealed. That is the part nobody tells you when they are trying to sell excitement. They do not tell you that the biggest edge in ordinary investing is often subtraction. Remove the fee drag you never questioned. Remove the yield temptation that was feeding your emotions instead of your future. Remove the headline dependency that kept renting out your judgment. Once those drains are closed, the portfolio does not have to perform miracles. It merely has to keep more of what productive assets were already going to generate. That is enough to change a life. $100,000 of avoidable leakage is not just a number on a screen. It is years of work. It is options. It is the ability to say no. It is the freedom to leave the wrong job. It is tuition for a child. It is medical resilience. It is the margin that keeps you from becoming desperate. It is the difference between old age with quiet dignity and old age with fear sitting at the kitchen table. That is why I take these details seriously, because they are not details. They are claims on your future freedom. And freedom is always more fragile than people think. It is not usually lost in one spectacular mistake. It is lost in tolerated leakage, in small percentages, in lazy assumptions, in emotional purchases, in outsourced judgment, in respectable little drains that seem too minor to matter until enough years pass and the bucket you thought was filling has been emptying the whole time. You do not need more excitement. You need a tighter bucket. You do not need a more persuasive commentator. You need a more disciplined process. You do not need to feel rich every quarter. You need to become harder to drain every year. That is the real threshold. Because once you understand how much of investing is simply protecting the compounding stream from theft, seduction, and narrative infection, you stop acting like a customer, wandering through a brightly lit market. You start acting like an owner, defending a reservoir. That is what I would want for you. Not cleverness, not adrenaline, not bragging rights, control. And control begins the moment you stop asking which ETF sounds exciting and start asking where the bucket leaks. That is the test. Not whether you can name the latest popular fund, not whether you can repeat somebody else's opinion, not whether you can collect a payout that flatters your nerves. The test is whether you are finally willing to look at your own capital with enough honesty to seal the drains before another decade disappears. Most people will not do it. They will keep choosing what feels stimulating, visible, and emotionally rewarding. They will keep admiring the label while ignoring the whole. You have a choice. You can keep renting certainty from headlines and collecting pretty little payouts while invisible friction feeds on your future. Or you can close the drains, protect the bucket, and let time work for you instead of against you. That is a small decision on paper. In real life, it is the line between owning a compounding engine and spending your life financing everyone around it.